Hey, good morning, everybody. Um, and Happy New Year to everyone. This is the first time we've had a Coffee with Kirk for 2024. I'm traveling this week, a little bit of vacation, a little bit of work. So this will probably be a little bit shorter than what we've had in the past. But basically, I'm just going to kind of take a look and see where could we be with the stock market. Is this, are we basically entering another full-blown bull market, or is there a bear market around the corner? And I'm going to use kind of history to kind of get a feel for where we are, because that's sort of what I'm programmed to do. I don't know, being a kind of history major at the Coast Guard Academy, and the fact that I'm always kind of looking at the past, because the past always rhymes with the future. So that pertains to human history, but it also pertains to markets as well. So we're going to take a look at that and just see where could we be, and trying to gauge on that. Now, I'm not going to say where we are, but I'm going to try to just show you some possibilities based on what's going on with history, because we'll never know either until we actually get to the back end when everything is in the rearview mirror. So let me share my slides as I always do. And we'll get going with it. Okay, so in 2022 we had a bear market that we saw the market go down 22%. So, the big question is, we've had a rally in 2023. Well, what's all that mean? Where are we really at in the cycle? Now, if you look back, we've really kind of been in a bull market since the financial crisis of 2008. So from 2009 through 2023, pretty much you can call that a bull market for the most part. And, the question just is, where are we going? A lot of people kind of feel like we've had such a run since 2009, and it's really been the longest run we've had, that we're due for a little bit of a bigger pullback that we could see. But, also there could be a chance that after the 2022 pullback, maybe we're entering a brand new stock market, bull market. So let's try to figure out what could be going on. And the thing is, it's important to know that, a typical bear market usually lasts about 5 years. In most cases, that's what you're going to see. You can see there's some that have been shorter and some that have been longer, but that's usually how much you're going to see with a bull market. And the typical bull market goes up about 170% from bottom to top. So that's typically what you see. And the other thing that you're going to always notice with bull markets is they always come after bear markets. There's never a point where you have kind of sideways markets or slowly upticking markets, and then you have a big bull market. Always happens after bear markets, and that makes sense. Everything's cyclical. So, if you have a big downturn, you're probably going to get a big upturn as well. So as you look at this and you see some of the big downturns, you can see some of the big moves up afterwards. And that's particularly true, for us in recent memory, the year 2000 to 2002, obviously 2008. And then if you look at the top right of this chart, little red there for that top in 2022. So we've had 10 bear markets that have seen greater than 20% declines. And that's typically what the definition is for a bear market. When you see a 20% decline or more, that's when you consider it to be a bear market. Anything less than that is just considered a correction. So since, roughly 64, we've had 10 bear markets of greater than 20%. Some of them much greater than a 20% loss. So that's those periods is where you're typically going to see the bulls come back after these bear markets. So if you look at this chart, that's basically what it shows you here is, since 64, we've had those 10 bear markets, and then we've had, 9 bull markets that have ensued with it. So are we in a new bull market, or is this just a bear waiting to happen? And as I mentioned before, the typical average uptick for a bull market is about 170%. So, from the 2022 lows, we've gone up about 20%. So do we have another 150% in front of us here before we have to worry about another bear market or not? Probably the longest bear market, maybe outside of if you want to say 09 to 23, but really one of the biggest bulls we had was from 1990 to 2000. We saw a 400% increase over that period, and that's not even focused just on the tech stocks. That was the big tech boom there, but that's just the general market overall. So from the recession that kind of ensued in 1990 until we peaked at the top of the tech bubble in 2000, you had a 10-year bull market where you saw a 400% move in the stock market. And so, that's sizably larger than the 170% average that we typically see. So if we were to say right now that what we're entering is something similar to the 1990 to 2000 market, you could see this market go on until really, 2030, and the S&P 500 would be up over 20,000, up to over 20,000. So, that's a pretty sizable move there. And you consider we're in the 6,000s right now for the S&P 500 to get to 20,000. So, if we're going to repeat that pattern, because, there are some similarities. The 1990 recession and the pullback, we had a 20% pullback, but it wasn't that bad, and the recession wasn't that deep. And then we had this phenomenal bull market coming off of that. So, maybe if you want to argue that 2022 was a recessionary year, and now we're coming out of that, but not a deep recession for 2022. And now we're coming out of it. You could see something similar to this. And the thing, again, the bear market bottoms are what's typically leads to boom. So when you get the big downturns, that provide some ample juice for the upturns. So here you can see from these bottoms. So this previous chart, we've identified all of the bottoms dating back to 64 for all the bear markets. And then you can kind of see the ensuing bull markets that took place thereafter from these lows. So it goes back to, was 2022 a low? Or was it just sort of a correction within maybe a deeper bear market that's coming? So there's pretty much been a recession with every single market bottom. So if you look at this chart, so every basically red point on this or maroon point on this is the stock market bottoming. But you can notice with every one of these single bottoms, almost, pretty much every bottom coincides in some way with the recession, which is in the gray bars. So usually what you're going to see is a recession, which precipitates the stock market bottom or the bear market bottom. And then from there, you see a nice move up with a bull market. But there are a couple periods where you didn't have a recession and you had a bear market. In fact, there's really only two, at least in recent memories. 1966 was a situation where you saw a 20% downturn in the stock market. And then you had an upturn, but there was no recession that caused the downturn in the market. And you can kind of see that there, the red dot is the bottom of that 66 bear market, and then the ensuing bull market that took place. If we're in a situation like it's 1966, what we would expect to see is the market continue to move up throughout 2024, and then sort of making a new high, and then peaking at the end of 24 and starting to decline in 25. Obviously nothing's going to be perfectly aligned with anything like that. But just to give you an idea, if what we're experiencing right now, if 2022 was basically a situation where the market went down without a recession, then it matches what might happen with 1966. And the other situation where we saw a decline in the stock market of 20% or more without a recession was 1987. And I'm sure probably most of you remember Black Monday in 1987, where the market lost that 20%. So you had a very rapid downturn in the stock market, but you did not experience recession along with that. And then you can kind of see that the market rebounded from there. So if we were going to see something kind of similar to 1987 today, again, a 20% decline like we had 22 without a recession, if it was going to continue that, then what you'd basically expect to see is that the S&P 500 could go up through 2025 and probably up another 20% from where we're at now. And then after 2025, if it was to hold with the history of 1987, you'd start to see the bear market show up then. So, the question is, looking at that 2022, you could argue for 66 and 1987, all those was kind of a bear market within a longer term secular bull market. So it didn't have a recession that associated with it. And here again, we're kind of just looking at those two markets as they stood. So really, when we had the bear market in 66, we were seeing a nice bull market in 64 and 65. And then the bear market in 87, really, we'd had a phenomenal boom from 1981, the end of 81 to 82, up through 87. Now, the question is, why are most bull markets bred from recessions? Why does that happen? And typically, what you're going to see in most recessions is people tend to tighten up their belts. Clearly, there's going to be people who lose jobs and face hardship, and then as the recession ends, they might find their employment, and all of a sudden they have disposable cash again. But for other people, even people who don't lose their jobs, typically folks are going to tighten their belts and not spend as much, not going to travel as much. They're not going to make any big purchases. So what you end up having is folks with excess savings. They've kind of been building the savings, and then you have what's called a pent-up demand. And with this pent-up demand, people want to spend this money. So it ends up providing a lot of fuel to the next bull market. So you can kind of see here that 1980 and during the financial crisis of 2008, people had a lot of excess savings as these two recessions came to an end. So the folks who continued to have jobs, they pulled back, but they continued to put money away and build up cash reserves. And then when they started to feel comfortable with the economy, they had pent-up demand and they spent this money. We also saw that happen when COVID-19 hit. So we had massive amount of government stimulus. So everybody was getting tons of savings, a lot of it coming from the government. So you can see the savings increased much more rapidly than we saw during 1980 or the financial crisis. But then we saw it basically be spent. And I've been talking about this for a while, that the amount of savings that we had from COVID is now gone, and we're at a point where people are seeing negative savings. They're going into debt. They're spending money on credit cards. Credit card debts are going way up, and defaults on those credit card debts is also going way up. So we now see something a little bit different, that we're way past having that kind of excess savings back, tailwind to help the stock market go. But, we did have some massive spending, and we saw the market after COVID for 2 years, it really accelerated. And those 2 years kind of matched the amount of excess savings that we saw spent by consumers. So you can see that excess savings really pushed it for about 2 years. And then we had the 2022 bear once the excess savings were gone. Now, does that mean, kind of that's where we're headed or not? I don't know. But, if we were to see, kind of the same stock market that we saw right after COVID for 2 years, you'd see the market go up considerably from here and really carry on all the way through probably mid-2025. Now, a lot of people are going to argue that what we saw in 2022 was, in fact, a recession. In fact, we did have 2 quarters back-to-back of negative GDP growth, and that is, by definition, a recession. So when you come back up here and you look at the downturn in 2022, what that really is, it was due to this recession. So you could make the argument that, hey, we're coming out of a recession, and that's what we started to see in 2023 is the recession ended, and we're heading up like most stock markets do when recessions end. Now, it's hard to tell exactly, was it a recession? So recessions are always one of the indicators you need to look for to see where we're at with the stock market. So if we recently had a recession, then you would expect to have that we're in a bull market. So again, the question comes back to, do we think that the small negative quarters that we saw in 2022, the beginning of 2022, was that the recession, and we're going to head upwards from there? So another thing to look at that affects markets historically is inflation. And this chart basically shows you the S&P 500 in the black line and the inflation rate in the blue line. And you can kind of, just from looking at this, you sort of see that when inflation's going up, that's typically bad for stock markets. But when inflation, slows down and subsides, it's actually a boon for stock markets. So could we be facing a really good stock market right now because we're seeing inflation start to moderate? So this chart right here shows you what happened with the recent inflation trend that we had. You saw we had in 2022 the stock market go down 22%. And then right now, what we're kind of starting to see, that this trend, we can look at the past and see sort of history from this. So if you go back to the history of a couple other big moves in inflation. So we're looking at, basically the end of the 60s, we saw a pretty big spike in inflation, and you saw the market decline. And then, of course, in 74, we saw a really rapid increase in inflation, and the market tanked at that point too. And I don't have it highlighted here, but if you go even up to, 1979 and 1980, we also had a very large spike in inflation with a downturn in the stock market as well. I just kind of forgot to highlight those, but you can kind of see that there. So maybe what we're seeing right now with the stock market is we had a big inflation push upwards, and the market took a turn down of 22%. And now that inflation's starting to moderate, maybe we're facing a nice bull market that's coming in, because you can kind of see how that sort of works as the inflation moderates. Back in in the early 70s, And then in 75, as inflation moderated, you started to see the stock market take off. And the same thing, again, I didn't highlight it here, but if you look at in 81, when inflation started to moderate and come down, that big spike started to come down. If you look strictly below at the stock market there, you see the stock market goes up. So maybe that's what we're seeing right now. Maybe we do have a lot of juice left with this bull market because the inflation has gone up substantially. We saw a market downturn, and now inflation is subsiding. So maybe the market does have juice. So maybe we don't have to worry about a stock market precipitated coming after a recession. Maybe it's due to the inflation. So, you have to look at different factors. So if it wasn't anything to do with recession, or if you say, yeah, that 2022 was a recession, well, then you look at this and say, well, maybe it's an inflationary. Maybe what the market's looking at is inflation at this situation, and we've got a bull market as inflation subsides. So yeah, again, as you see inflation peak, I did highlight the 81 peak here, but as you see inflation peaks, you do see stock markets start to do quite well. And here again, we're showing you the three previous ones. You can see we if that's the case, we could have a few years here. When the first one in the late 60s, when we had that downturn, really we had a bull market from 1970 to 74. So that was a 4-year bull market. Excuse me. And then from 75, after the 74 bear market, it went up for 4 years up to 79. And then obviously once we got through the 79, 80 inflation and downturn, and the 81 downturn, from 81 on really until 87, we had a 6-year upturn without any kind of a bear market. So you could say, hey, we are looking for a pretty good run here in the bull market. Now, the only thing that you could look at and say there's a little caveat is, in the past, when we've had those high inflationary periods, we've actually had a recession coupled with it. So, when we look at the high inflation of, 69, we had a recession. Same with in 74, when we saw that spike, we had a recession that came in. And again, didn't highlight it here, but if you look at 1981, the last big spike there of inflation, we also had a recession in 81. So the previous periods I'm talking about, where we had high inflation and then inflation receded and the stock market took off, it was also the same point where we were coming off a recession, as we said at the beginning. Typically, you see bull markets come alive after a recession. The other thing to look at, another factor. So we've already looked at, recessions. Bull markets are fed off of recessions. Bull markets are fed off of inflation easing, but bull markets are also kind of set off when unemployment is hitting a high, which also usually is precipitated by a recession. So if you go back to that 1970 and 1975, where the markets took off, well, you can see in both cases, it kind of took off as inflation was peaking and coming out of a recession. Even if you come down and look at some more recent examples. So if you look at the, say, 01 to 01, 02, or actually 2000 to 2002 bear market, the next ensuing bull market starting in 03 took place after the inflation, after unemployment had hit a high. Same as 09, when the unemployment rate hit its peak, is when the stock market started to do its thing. And even during COVID, we had a huge spike in unemployment due to the COVID shutdowns. But once those opened up and unemployment had peaked, that's when we saw everything kind of normalize in the stock market. So here again, you can kind of see as unemployment in those first periods were rising along with the recession. Once that ended, that's when we sort of saw the stock market, bull market take place. And this is another graph kind of showing you the S&P 500 compared to the unemployment rate. So when you look at the gray line there, which is the S&P 500, all the red points there are market bottoms. And if you compare it to the sort of orange line with the highlights that I put in there, you can kind of see, excuse me, every one of those bottoms in a stock market were pretty much when unemployment was peaking. So when unemployment peaked, that's when you started to see, the market turn into a bull market. And it kind of makes sense. You always hear that buy when blood is in the streets, even so, if some of that blood is your own. That's what we're seeing here. So when unemployment's hitting its high and people are feeling like, things are falling apart and things look their bleakest, that's when the stock market tends to turn into a bull market, a raging bull. So this is just another graph kind of showing you the actual point-to-point top part of the unemployment rate compared to the stock market bottom. So you can kind of see in every instance, the stock market starts to turn up right before unemployment peaks. And that's why I've been talking about the past year that, unemployment is essentially a lagging indicator for everything. So by the time you get to peak unemployment, the recession's over and the stock market's off and running. And the one thing to notice, though, and I want to make a note here, is if you look at the current situation, we're still at a low unemployment rate. If you go all the way to the far right and look at the current one, we're still, sub 4% unemployment rate. So we have not, if what we're facing right now is a bull market, if what we're starting to see is a bull market in stocks, then it wasn't precipitated by any kind of peak in unemployment, and probably not one for a recession. I mean, some people are going to argue that those 2 quarters in 2022 was recession, but we really didn't see much unemployment at that point. So, really the hope here for the stock market is either the fact that it's due to inflation subsiding, or we're facing a situation like we had in 66 and 87, where you had a downturn without a recession, without increased unemployment, and without increased inflation. And it was just sort of a pullback, and then the market continued on for a couple of years before the next downturn. So that's sort of what we're looking at. So right now, the unemployment, that story doesn't fit with a strong bull market. So the last thing to kind of look at outside of unemployment, recessions, and inflation would be, what's the Fed's fund rate? What you usually see is that bull markets do well when you have low interest rates, and all of these spikes. So the green line here is the Fed funds rate, and then the black line's the S&P 500. So every time you see the green line kind of hit its peak, you start to see the stock market do well. And once rates start to come down, either a pause or you have them actually come down. So this, again, we're looking here at the 1966 and the 1987. Both of those bull markets that ensued from those corrections were kind of in a situation where we had low interest rates. So interest rates were low. So that kind of provided some fuel to the stock market. You can sort of see how they both were much lower. In 66, 67 rates were coming down. So that provided some fuel for the bull market. And then in 87, while they weren't necessarily coming down then, they weren't going up, and rates were pretty low relative to what they had been just a few years before. So you actually had the Fed helping the stock market in this situation. So this chart basically is expanded out to current times, and you can kind of see the first two circled areas where that's 66 and 87. But and then of course on the far right is our current situation. Now, I don't think that we can say that the Fed is helping here, at least yet, because when we saw the 2023 market go up, interest rates were still climbing. We didn't have low rates like we had in that 66 and 87 period, where we just had a correction out of nowhere and then the market continued up. So I don't know if we can really say that it's like 66 and 87, at least, from this aspect, because rates aren't cooperating the same way they were during those periods. So, maybe, looking at other things, what else could it be? Historically, it could be a situation similar to what we had in 1994 and 1995. We had a situation, excuse me, where the stock market kind of struggled a little bit as rates went up in 94. But then what ended up happening was the Fed sort of paused in 95. They didn't pull rates down, but they kind of just stayed where they're at. So we had a big increase. Again, looking here, we had an increase in rates, a sizable increase. And the market, kind of went sideways. We had a little bit of a correction in there in 94, and then it recovered that. But then because the Fed just kept rates where they were and the market normalized, we saw a 250% increase from 95 all the way up to 2000. So could we be in a situation if the Fed has come out and said that they're probably done raising rates and they expect they might be cutting in 2024? They're saying basically 2 to 3 cuts possibly. So if we're in that kind of situation, maybe we are in sort of a Goldilocks, similar to what 1995 was, where the rates just kind of at least stabilized, maybe came down a little bit, and the stock market took off for a 5-year period and saw a sizable increase. That could be another scenario that, as I look historically in these things, maybe that's something that could happen. And I think that's kind of a best case scenario, quite honestly. Now, if you look historically at most of these things, when the Fed peaks, and we've talked about this in the past, when the Fed's fund rate peaks and rates start to come down, the stock market actually declines. For the most part, except for that 1995 period. Every other period where you kind of see the Fed funds rate peak, you see the stock market then come down after as rates come down. And if you also look at this chart, every point where the Fed funds rate is peaking, that little red dot on the green line, typically what you see right after that is a recession. So usually the Fed doesn't lower rates unless they see economic pain in the future or they're experiencing economic pain. So, right now where the Fed is at this point, the only reason we'd expect them to really bring rates down is because one of two things: either they feel they've conquered inflation, or secondly, they start to see some economic pain. And I don't think they're going to be too fast to lower rates unless we see some sort of recessionary signals. But in the past, outside of that 1995 period, every time that we've sort of peaked at the Fed's fund rates and the Fed fund rates come down, you see a recession ensue and you see the stock market decline precipitously. So again, which history is going to play out, I don't know. That's something that we'll see after the fact, but just trying to put things in perspective. So the best case scenario is we're seeing something similar to 95, or the Fed sort of just stays on hold, maybe cuts rates a little bit, and the market adjusts to it and has a nice run from here. But if we see the Fed cut rates, because usually when they're cutting rates, it means that the economy's struggling. At that point, we probably see the market decline and fall into recession. Now, you can still have, even when the Fed starts to, cut rates or moderate before a recession, you can still have a pretty good run in the stock market up until things really, really hit. So this chart shows you right before the great financial crisis of 08. You can start to see the green line again is the Fed's fund rate, and then the top line there is the S&P 500. And well before we hit the 08 recession, the Fed was raising rates pretty rapidly. And you can kind of see the market, while it didn't necessarily go down, it kind of just went sideways over that period. And then what you saw is when the Fed finally just stopped raising rates, they didn't even start to cut rates, but they just stopped raising rates and went sideways for a while. Well, we saw a period there right before the financial crisis hit that the market went up 30%. So as you know, I've been kind of calling for a recession here for a while. So let's say that that's the case. And we're in a position where what we're seeing is the Fed's fund rate moderate, at least go sideways. And what we saw in 2023 with the stock market going up 20%, that could match what we're seeing right now. And it also could mean that the market's got a little bit more leg room to go at this point. It could be something that might have another 10 or 15% if we are facing any kind of recession coming. Another period where that sort of happened was right before the 1990 recession. We saw the Fed raising rates pretty rapidly in 89, and the market kind of went sideways. But then when they sort of paused in 89, we saw the market go up about 30% right before that 90 recession. So it could be a situation that we have more room to go for this year and maybe even next year, even though there could be a recession coming because the Fed's kind of going to go sideways at this point. At least they've said they're going to go sideways with maybe 1 or 2 rate cuts. So that's not a big move down. The only time we start to see big moves down is if we're really heading into recession. So as I said, if what we saw in 2023 was the start of a move upwards because the Fed was moderating their interest rates, and we see the Fed kind of stay put where they're at right now, not necessarily cutting much, but not raising anymore, based on that, we could easily see another 10% in the stock market go up from this point, if we're using history as any kind of guide. And we could see it continue even further than that, but then you'll see something kind of fall apart after the end of this year because the market's already gone up 20, so we might have 10% left, based on history, and then we'd start to see things kind of fall apart at that point. But again, the biggest thing is who knows exactly what's going to happen. You try to look back at history and see how does today's situation rhyme with what we've seen in the past? I mean, is there any correlation to them? Is there not? It's always hard to say. So, the thing is, though, most bull markets happen when you have a recession. Most of them come out after we have a large pullback. And that happens because we have a large pullback, but also because you have excess savings. Along with those recessions, typically you're going to see unemployment spike up. So usually when you're seeing high unemployment and you see that recession, that's where you start to see the next bull market really come out. It was 2022, the 2 down quarters, was that much of a recession? A lot of people dismiss it. Obviously, the White House said, "Oh, that's not the definition of recession." I mean, technically it is a definition of recession, but it wasn't really a deep, strong recession. We didn't see unemployment go up at all because we were still kind of coming off bringing people back to work after COVID. So maybe it isn't. But you could look at it, historically, inflation, when you have inflation spike like we've had, and then it moderates, that's always been good for markets. So, on the one side, you say, yeah, we're not in a bull market right now because we didn't experience a recession and high unemployment. And then on the other side, you say, well, maybe we do have a bull market because we are seeing inflation kind of recede here. And that's usually always good for the stock market. And then there's those periods that you really can't explain. There's no recessions, no high unemployment, no inflation, like 87 and 66. They were just downturns. Kind of like, using an example, you're out sailing in the water and you just have a rogue wave that kind of hits you. That's sort of what we saw there. So if 2022 was more of a rogue wave, that we just had a big downturn without any real big reason. I mean, obviously inflation, I think you could say, was a huge reason for that downturn, but for the most part, nothing like a recession. Well, then you could see, another 1 or 2 years of a bull market here if you correlate it back to 66 and 87. So that could be the case that we're facing right now, or it could be looking at the Fed's fund rate. If the Fed stays where they're at, maybe cuts once or twice, but for the most part, they're done raising and we're going to stay where we're at. You could see a period of an increase here, another 10, maybe even 20% to the upside for this year, maybe even into 2025 before we have some sort of downturn based on that. But if we see the Fed cutting rates quite a bit, then they're only going to be doing that if we're having a recession or economic pain. So again, I probably confused you more than anything. Probably looked at me to have a definitive, hey, this is what's happening. But obviously nothing's perfectly clear in markets. So I just wanted to do an exercise to see what could it be. And that's how I'm looking at the markets. I'm trying to, see is, what's more applicable. Now, I still think recession's on the way, but it may not be. And if it's not, well, we could have a bull market due to the decrease in inflation, or maybe even just moderation by the Fed. So it's just something to kind of, watch and look at the economic indicators and see what's happening. So anyway, I hope you're off to a great start of your new year. And if you have any questions, please let me know. Take care, everybody.